Today we are analyzing Humana Inc., ticker HUM. Over the next few minutes, I'll discuss my thoughts on both valuation of this company and its business quality. This company has a market cap of $61.8 billion and an enterprise value of $55 billion, which is really exciting because that is $5.5 billion of net cash on this business. A lot of the companies we look at have net debt. This company has net cash of about $5.5 billion, so we're seeing about 10% of the enterprise value is net cash. This is in the healthcare provider and services industry. So they operate a health and well-being company in the United States. Two segments. They have insurance and CenterWell. So the insurance would be medical and supplement benefit plans to individuals. It also has contract centers for Medicare and Medicaid, limited income, newly eligible transition prescription drug program, Medicaid. What is this other one? Pharmacy solutions. What is CenterWell? Okay, it doesn't say what CenterWell is here. Maybe that has to do with these home solution, home health services, and different things like that. So beta of 0.67 significant because that's 33% less than the average S&P 500 company of 1.0. So that means it's going to be a little bit less volatile. Anytime you see that low beta, that's a positive sign that's signaling to me this is a relatively high quality business. Let's get down here to return on equity. So one difference with insurance companies is in QuickFS, they show you return on equity instead of return on invested capital. So 90% of my videos are going to be return on invested capital charts. This is a return on equity chart. So it is a little bit different, but you can instantly see they have 20 straight years of profitability. They have data going back to 2002 or to 2000, actually look, 22 years of profitability here. Profitable every year since 2000. That's a very good sign. Tends to be a sign of a high quality business. They do bounce around a lot. That's not uncommon for an insurance company. You see lows here of 6% in 2000, 6% in 2016, but you get highs of 23%, 26%, 23%. So you have some good highs. One thing that I really like is they spend most of their time here between this 10 and 20% mark. They do sometimes go above 20%, and they're really hugging this mid 15+% range, which is my target for return on equity. And as we see on the 10-year median returns, 17% average return on equity over the last 10 years. That is certainly sufficient for me to say this is a high quality business. So excited by what I see there as well. Now, one thing is we're going to get some different data with insurance companies, price to premiums, EV to premiums, price to sales. Premiums and sales are a little bit different sometimes with insurance companies. You're really looking at this earned premiums mark. That's going to be a lot more close to something like a gross profit number. And so revenue isn't always the key number you're looking for in the insurance business. Those premiums really make a big difference. Price to earnings of 18.3 seems reasonable. Again, I'd really like to buy companies PE of 15 or less. This is about 20% higher than that. But of course, high quality businesses tend to trade close to that 20 PE mark. Nothing unheard of there. One thing I really like, though, is the growth on this company. 9% revenue growth, 9% premium growth. The fact these track together is a good sign. You're growing premiums faster than assets, which is good. And we're seeing a little bit of operating leverage because the EPS is growing at 11.4%. One thing that's very attractive about a company that is growing its earnings faster than 10% is we can rely completely on earnings growth in order to get our 10% return as a shareholder. That's a very positive sign. So I like that I'm seeing there. I can see clear paths here owning this company to getting the double-digit returns that I want to have. Now, we need to go down to these actual numbers here. Again, I'm going to skip past this total revenue, go to earned premiums. You can see here the speed at which they're growing. They went from $38 billion in earned premiums to $87 billion in earned premiums. Again, that's more than doubling over the course of a decade. So it's a pretty good premiums growth rate. You see some years, single digits, some years going 18%, 14%. There's only a single year here where they decline, but they quickly bounce back and grow pretty rapidly after that. So good sign there. You can see the underwriting profit has grown from $8.3 billion to $16.8 billion. So you've basically doubled your operating profit over the course of a decade. Again, that is a good sign as well. Your earnings per share have grown substantially faster than that, going from $7.73 to $22. It's not quite a triple in a decade, but it's getting really close. And so that's a good sign that I like to see. Likewise, your dividends have tripled in the course of a decade. And what's nice to see here is that you're paying a dividend. You're able to earn an 11% growth rate in earnings, a 9% growth rate in revenue while still paying out a dividend. We can look at the dividend yield here of $3.15 to $495. So it's a price on the stock price. So it's a little less than 1% on your dividend yield. So it's not a huge dividend yield here, which makes sense. You're growing very rapidly, so they're having to reinvest a lot of that capital in order to grow. Again, that's very common for an insurance company. It's not surprising. It's actually impressive that they're able to still pay that dividend and grow so rapidly. So I do like what I'm seeing here so far. This company is tracking towards my watch list based upon what we've seen. We need to do a little bit further analysis on the financial statements. But if you're enjoying this video so far, hit that like button. Don't forget to subscribe. Let's go look at the income statement. So we see, premiums earned here, net investment income, this income here on investment income and fee income is important income. It is an important source for the company, but you can see the big gap here. This company is definitely earning a lot of money from premiums and not earning a lot from investments. They're really earning their returns on the underwriting side. That's what it really tells me here. You're not seeing a big amount of investment income. It exists, but you're talking 10 to 20% of the overall net income coming on that investment income line. But you also have a lot of interest expense, so those numbers offset to a decent degree as well. What you're really seeing here in this pre-tax income line, of course, is you have a gap here between policy benefits and claims and the net premiums earned. And so that's going to show you some of your underwriting profit, which you're seeing here on this line item. Now they're paying taxes. So one of the reasons that our EPS is growing faster than our revenue is that we have a decline in our share count. We went from 159 million shares outstanding to 127 million shares outstanding. So they cut out about 32 million shares. That's close to, let's say, a 20% decline in shares outstanding, maybe somewhere between a 1.5% to 2% boost in our EPS growth from that retiring of shares, which is a key explanation here for why we would go from 9% revenue growth to 11% EPS growth. Very clear how we get there. Strong method of hitting those double-digit returns that I like to see. I'm liking what I see there. That is a very good thing. Now, one thing that I would like to note, though, is one of the reasons your EPS grew so quickly is you did have the Tax Cuts and Jobs Act, so you're paying less in taxes than you would have beforehand. So just keep that in mind. That is giving maybe the other 0.5% growth here in this EPS line, then that part isn't repeatable. Let's see, securities and investments. They have about 14 billion in securities, 5 billion in cash. Okay, so 20 billion almost there out of enterprise value of 55 billion. Let's go to balance sheet. How we compare that to our debt, you want to get an idea of their long-term debt. You see the long-term debt here is 9 billion. Their debt is going up, but again, this is an insurance company. They have, long-term debt, short-term debt, 11 billion here. They have more in securities than they do in the debt. One thing that's important is that they don't have a lot of PP&E, 3 billion in PP&E. You compare that to the income statement, 3 billion in net income, very low capital intensively on the PP&E side. Where's the capital going? As it's an insurance company, you're going to have investments, you're going to have cash. Those investments are helping to be invested during the period where you're collecting premiums and before you pay them out. Now, I believe this is health insurance is a big part of this business. Health insurance tends to renew on a relatively frequent basis. These are not long-term policies. It's not like you take on a policy in 2023 and it doesn't pay out until 2063, like let's say a life insurance policy. So you don't have long periods of that investment. You're investing over the course of the year and you're having probably high renewal rates. It just changes the dynamics of this business a little bit, something to be aware of there. Now you do have these other current liabilities. I don't know what's meant to be here. I'm assuming it's something relating to claims, anticipated claims, different things like that on this other current liabilities. That would match up well with our premiums as well as securities. You can see those numbers matching decently there as well. So, one thing I want to note though here is, do you have retained earnings 7.8 billion to 25.4 billion? One of the things I noticed, they're growing rapidly. They're retaining a lot of earnings to do that. Now they're getting good returns on capital, good returns on equity. You're seeing that here. That's what you want to see. You want to see this 17% because if you're retaining a large amount of your earnings and you're earning a 17% return on those earnings, your investor is going to get your investment tending towards your return on equity over time. That is a really good sign for you as a shareholder that you're going to likely be able to continue to attain double-digit returns as long as you can get those double-digit returns on your capital. So I like seeing that, whether they're retaining that, they're able to grow, and they're doing well there. Now they have some constant investment in PP&E. Not a huge amount, but you can see that appreciation has trended up over time from 400 million to 800 million. Part of that is because they were investing 400 million a year in PP&E. That's increased up towards $1 billion. So we should continue to expect depreciation to continue to go up over time because of all that investment. They do have stock-based compensation. I don't like that. But what we can see here is they're buying back shares every single year. Most years that is exceeding stock-based compensation. Not every year. You can see in 2016 it was actually higher. In 2021 it was actually higher. But a lot of years it's significantly exceeding it. And so you are dropping that share price significantly over time. So a lot of money being spent on buybacks, money being spent on dividends every year, and a lot of increases in debt over time. You shouldn't expect this company to deleverage based upon their history. They've been continuously going up in that regard with the leverage. Nothing concerning there. Overall, though, I like what I see here from Humana. This seems to be a high-quality business. You have 17% return on equity, 22 straight years of profitability. You're growing at a high single-digit rate with premiums, 9% growth. 10% would be amazing, but 9% is a really good growth rate. You're trading at a reasonable price. PE of 18 with all these metrics is probably reasonable. It could be fair valued. It could be undervalued at this price because of these growth rates. These growth rates being reinvested at 17% rates of return is a very strong amount. You're able to completely self-fund your growth. So why are you taking on more debt? You're taking on more debt in order to boost your return on equity. And so that's being able to boost your returns because you're able to, go from a 4% return on investment, 17% return on equity. Good signs here in how this company is being managed. If they can repeat this over the next 10 years, I think shareholders would do really well. And so for that reason, Humana would go on my watch list. Very good potential for future returns that get into the double digits. Seems pretty stable, profitable every year. I like what I'm seeing here. So if you learned something from this video, hit that like button. Don't forget to subscribe. And you can check out all the other watch list companies with the playlist up above, or check out the below video for one that is recommended to you by YouTube. Now, quickfs.net is the tool I used to make this video. I really enjoy it. I hope you'll check it out. It is the first link in the description below. That's my affiliate link. You sign up using that link, free or paid account. Helps me by giving me a commission for sending them over there. I use it myself. I highly recommend it. Thank you for listening, and until next time, stop paying fees, start building wealth.